All right, welcome to this Executive Explainer. Today, we're going to definitively dismantle the structural barriers that are keeping scaling businesses totally locked out of institutional B2B markets. You know, if you've ever felt like your company is just hitting this invisible wall every time you try to land a massive enterprise contract, you are in exactly the right place. We're diving into the undeniable math and the exact financial architecture you need to break through what we call the B2B glass ceiling. Let's get right into it.
So here's our game plan for this boardroom briefing. First, we'll diagnose that B2B glass ceiling. Then, we'll break down B2C versus B2B tax dynamics and look at the anatomy of the toxic counterparty. After that, we're running a discount fallacy simulation. And finally, we'll wrap up by architecting the major leagues.
Okay, part 1. The B2B glass ceiling, hitting the institutional wall.
So, picture this. Your enterprise is scaling, and you're finally targeting the big institutional players, right? We're talking major manufacturing plants, international telecom corporations, massive government projects. But then you hit a literal wall. It is so incredibly frustrating. You are bringing competitive pricing and superior products to the table, only to get completely locked out by enterprise procurement. Why? Simply because you operate under the simplified tax regime. You're out there running a highly efficient business under a 6% simplified turnover tax, plus that 1% municipal surcharge, and yet these enterprise buyers systematically reject your bids. There's no way around it. To fix this, we have to look past your actual product and look directly at your fiscal mechanics.
Moving on to part 2, B2C versus B2B tax dynamics, the paradigm divide.
To really understand why this rejection happens, we have to look at a fundamental divergence in the market. What works like an absolute charm for a retail consumer is actually a massive liability for a corporate buyer. It's a complete paradigm divide. See, retail consumers only care about that final gross price at the register, but an enterprise CFO, they evaluate contracts strictly on the net after-tax procurement cost. Think about it for a second. Your everyday retail customer doesn't maintain a corporate balance sheet. They definitely aren't filing complex corporate tax returns. They just look at the price tag and pay. But in the B2B world, these institutional corporations operate under the general tax regime, which means they are governed by a mandatory value-added tax, like the 14% rate in Tajikistan, for instance, and corporate profit tax. So to them, your gross invoice price is completely irrelevant. Literally, the only thing they care about is the cost after taxes.
Which brings us to part 3, the toxic counterparty anatomy. Financial friction in the supply chain.
Now, this divide builds into what international corporate finance harshly categorizes as a critical fiscal liability. Basically, if your fiscal status causes structural friction, or if it forces the enterprise buyer to absorb tax penalties, you are mathematically defined as a toxic counterparty. I know it sounds absolutely brutal, right? But to an enterprise buyer, it's just cold, hard business. A toxic counterparty is just any vendor whose legal or tax setup actively harms the contracting enterprise by causing tax disallowances or increasing their audit exposure. And spoiler alert here, if you are on the simplified tax regime and you're trying to sell to a massive corporation, you are exactly this.
So here is the crucial takeaway. When an enterprise buyer purchases from a standard VAT-registered vendor, they generate a critical fiscal asset, a 14% input VAT credit that directly reduces their procurement cost. The math is super straightforward. Their net corporate procurement cost equals the gross invoice amount minus this magical 14% input VAT credit. So when they buy from a tax-compliant vendor, they're essentially unlocking a massive discount directly from the state in the form of a tax credit.
Let's actually follow that money for a second. The enterprise then takes those accumulated input VAT credits and deducts them from the output VAT they collect from their own customers, so they only end up remitting the net difference to the state treasury. They collect VAT when they sell their finished products, sure, but thanks to the compliant vendors they bought their materials from, they get to subtract those input VAT credits. It keeps their tax bill perfectly balanced and absolutely protects their operating margins. It's a beautifully efficient machine.
But what happens when that fiscal chain is broken? Say, by an STR vendor who physically cannot issue an electronic VAT invoice. Well, the CFO is mathematically forced to absorb a voluntary 14% tax penalty on their own supply chain, which is obviously completely unacceptable. As an STR vendor, you literally cannot issue a statutory electronic fiscal VAT invoice. Because of this, the corporate buyer gets absolutely zero input VAT credit, meaning the entire gross price you charge them gets absorbed straight into their costs, and they have to pay that 14% output VAT out of their own pocket later. Honestly, to a CFO, hiring you is mathematically equivalent to volunteering for a tax penalty. No wonder they say no.
All right,
Part 4. The Discount Fallacy Simulation, Proof by Mathematical Simulation.
A lot of founders try to solve this structural barrier with what we call the discount fallacy. They just assume a simple 5% to 10% price cut will magically compensate for a missing VAT invoice. Well, let's put that to a rigorous boardroom test. Imagine a major industrial plant in Dushanbe procuring raw materials. On one side, we have vendor A. They're on the simplified tax regime, and they offer an aggressively discounted 100,000 TJS bid. Since they have zero VAT credit to offer, the effective cost to the enterprise remains exactly 100,000 TJS. Status: Toxic Counterparty. Rejected. Now, on the other side, we have vendor B, operating on the general VAT regime. They bid a much higher 110,000 TJS, but embedded in that gross bid is over 13,500 TJS in statutory input VAT. The enterprise gets to deduct that, dropping their effective cost down to roughly 96,491 TJS. Vendor B instantly becomes the major league partner and wins the contract.
When we map out the effective net cost of goods sold for the enterprise buyer, the discount illusion shatters completely. The mathematically more expensive bid actually ends up costing the enterprise significantly less. Vendor A's aggressive discounting strategy was a complete failure. Even though they walked into the boardroom with a price tag 10,000 TJS cheaper on paper, their lack of VAT compliance made them the most expensive option in reality.
Now let's look at the exact margin. Despite vendor B submitting a gross bid that is 10,000 TJS more expensive on paper, the net economic cost to the enterprise CFO is exactly 3,508.77 TJS cheaper. This specific number is the exact margin of victory. It is the undeniable mathematical reason why enterprise procurement departments systematically reject simplified tax regime businesses. It's not personal. It has absolutely nothing to do with the quality of your product. It is purely about that net after-tax procurement cost.
So, the boardroom verdict is crystal clear. Vendor B wins the contract because they are mathematically cheaper. And, as a huge bonus, their automated e-invoices eliminate administrative friction and state tax cross-check audit risks. It's a total double win for the enterprise CFO. They save over 3,500 TJS on the bottom line, and they completely avoid any cross-check audit risks associated with non-VAT suppliers. Vendor B is safe, they're compliant, and they're cheaper.
Which brings us to our final section, Part 5. Architecting the Major Leagues, the Systemic Solution.
So, the million-dollar question: how do we actually fix this for your business? Listen, to enter the major leagues of regional commerce, you cannot hustle your way out of a structural tax problem. You have to rebuild your foundation by executing two very specific architectural upgrades. Step 1 is a major mindset shift. Stop discounting your value and execute a voluntary VAT registration to graduate to the general tax regime. Align your tax architecture with the big players before you're forced to. Step 2 is adopting the right technology to handle it, like Odoo ERP. Manual paper invoices are totally obsolete in today's digital tax landscape, so you need full automation.
By adopting Odoo, you completely automate the generation of API-validated electronic fiscal invoices, and you maintain real-time ledgers of your VAT offsets. You achieve absolute B2B compliance with zero manual friction. The second you confirm a B2B sales order in Odoo, it automatically generates that all-important electronic fiscal VAT invoice. It transmits the exact input VAT credit data straight to your enterprise client's accounting portal and to the state databases. Plus, it dynamically tracks your own offsets in real time. It literally transforms you overnight from a risky manual vendor into an integrated, frictionless, strategic partner.
The math here is absolutely undeniable. So, the only question left for your boardroom is this: are you going to cling to the simplified regime that's keeping you small, or will you architect the financial compliance that actually scales your enterprise? Are you going to keep offering unsustainable discounts and remaining a toxic counterparty, or will you upgrade to the general regime, automate your compliance with Odoo, and claim your permanent ticket to high-volume enterprise contracts? The choice is entirely yours, but now you know exactly what the enterprise CFO is looking for. Thanks so much for joining me in this explainer. I hope it gave you the exact blueprint you need to shatter that glass ceiling.